For years, one of the biggest fights over crypto in the US has been whether and when digital assets should be treated as securities. Now, the US Securities and Exchange Commission or SEC wants to provide greater clarity. On August 18, it proposed regulation crypto assets, a framework designed specifically for certain crypto assets and the investment contracts associated with them. So what exactly is the SEC proposing and how could it change America's crypto market? One of the biggest changes involves how crypto projects can raise money. The proposal creates two potential fundraising routes for eligible projects without requiring the full securities registration process. The first is a startup exemption. It would allow an issuer to raise up to $5 million over 4 years. The second is a broader fundraising exemption, allowing offerings of up to $75 million in any 12-month period. But this does not mean a free pass. Both routes will come with disclosure requirements tailored to crypto assets. And at certain fundraising thresholds, issuers would also have to provide financial information, including audited financial statements. The proposal also tries to address one of crypto's most complicated legal questions. A crypto asset may not itself necessarily be a security, but the way that asset is offered or sold as part of an investment contract can bring securities laws into play. This distinction has been at the heart of several major crypto disputes in the US, and that's where the SEC's proposed investment contract safe harbor comes in. Under the proposal, an issuer could certify that it has completed or stopped the essential managerial efforts it had promised to undertake. If other conditions are also satisfied, the crypto asset would no longer be treated as subject to that investment contract for purposes of the securities definition. In simpler terms, the SEC is trying to clarify when securities law's obligations tied to an investment contract can come to an end. So is this America's new crypto law? No. First, this is an SEC proposal, not a law passed by Congress, and it is much narrower than the broader Clarity Act. The Clarity Act seeks to establish a wider regulatory framework for digital assets, including rules for digital commodities, intermediaries, and the respective roles of the SEC and the Commodity Futures Trading Commission or CFTC. SEC Chairman Paul Atkins has also said legislation from Congress is still necessary. So the SEC proposal addresses part of America's crypto regulation puzzle, not all of it. What does this mean for India? India is dealing with a similar regulatory question but from a very different starting point. Crypto transactions are taxed and virtual digital asset service providers are covered by anti-money laundering requirements. But India still does not have a comprehensive statutory framework covering the entire crypto market, including issuance, trading, intermediaries, and investor protection. A parliamentary panel has recommended examining such a framework and in the meantime considering recognizing self-regulatory organizations under the oversight of a designated regulator. So while the US is developing more specific regulatory pathways for crypto assets, India is still debating what its broader regulatory architecture should look like. For now, the SEC's framework remains only a proposal. But if adopted, it could mark an important shift in US crypto regulation by creating clearer, crypto-specific pathways within the existing securities law framework. It would not, however, settle America's wider crypto debate. That will still depend on Congress, the SEC, the CFTC, and how responsibility for different parts of the crypto market is ultimately divided. Follow Business Standard for more such stories.